record revenue, and an interim dividend hike of 60%. But why did Food Empire's share price slip by more than 5%? In my latest post on the Fat Investor, I break down the first half performance to highlight the good, the bad, and what the market is currently missing. Let's get right into the hard numbers. Total revenue jumped a very healthy 15% year-on-year to US $315 million, driving a normalized net profit growth of 12.2%. Add to that, management actually surprised investors with a massive 60% bump in the interim cash dividend payout, and that's after factoring in the recent bonus issue. Look at this on paper, and it's an absolute home run. Yet the market gave it a cold shoulder, dropping the stock over 5%. So what exactly is going on beneath the surface of this paradox? To understand the full picture, we need to first validate the core business. So let's start with the good. 3 specific things we absolutely love about this first half performance. The structural thesis keeping this stock compelling really rests on 3 main pillars of strength. First, we have Central Asia emerging as a high-quality rising star. Second, net profit margins confidently sustained above that crucial 10% threshold. And third, historical data pointing to an even stronger second half. Let's break down Central Asia first. 33.6%. That is the massive year-on-year sales surge in Central Asia, hitting US dollars 60.5 million. What's absolutely crucial to note here is that unlike the Russia segment's ruble-driven boost, Central Asia's growth is almost entirely organic. We're talking about pure underlying sales volume expansion across Kazakhstan, Uzbekistan, and Turkmenistan. And get this, they achieved this despite massive supply chain headwinds stemming from the Middle East conflict. Plus, with their new coffee mix plant in Korgos, Kazakhstan coming fully online this year, they're perfectly set up to bypass logistical bottlenecks and fuel this regional expansion for years to come. Moving to our second pillar of strength, a sustained double-digit net profit margin of 11.2%. Now this is a huge deal. Food Empire has basically left its legacy era in the dust. The days where margins hovered around a mere 5% to 8% are gone. How did they do it? By building a multi-regional footprint that gives them immense operational flexibility. They can strategically pull back or harvest high margins in mature markets to defend the bottom line, while simultaneously acting aggressively to seize market share in growth regions. Combine that agility with the structural cost benefits of their upstream ingredient operations in Malaysia and India, and they've permanently leveled up their profitability profile. And that brings us to the third piece of the good. Food Empire's business naturally leans into a historically stronger second half. Why? Well, it's simple really. Winter. Seasonal coffee consumption cycles across Russia, Central Asia, and Europe consistently drive demand up as the weather cools. If this first half momentum carries forward as a baseline into the second half, we're projecting a full-year fiscal 2026 post-bonus earnings per share of roughly $15. And with the board confident enough to hike the interim dividend, it is highly possible we see an $10 full-year payout, effectively matching last year's total distribution on an expanded share base. But hey, the market sold off for a reason, right? Let's shift gears to the bad, and I'm using air quotes here, to see what specific friction points actually spooked the short-term investors. It really boils down to 2 main things, starting with profit growth dynamics. Think back to the first half of 2025. Food Empire saw a massive 35.7% profit jump, but that jump was fueled by operating leverage. Specifically, they were selling at updated, higher retail prices while drawing down on older, much cheaper raw material inventory. Fast forward to the first half of 2026, and reality has set in. Peak Robusta coffee bean prices meant the cost of goods sold shot up by 14.8%, perfectly matching the top-line sales growth. That operating leverage basically vanished, holding gross margins flat at about 33%, and resulting in a more modest 12.2% net profit growth. The market? It didn't like that normalization. The second perceived negative was Southeast Asia. After years of rapid expansion, revenue growth in the region decelerated sharply to just 2.4% year-on-year, landing at US dollars $79.3 million. On the surface, sure, that looks like stagnation. But again, context is everything here. As noted by analysts, this wasn't a failure to sell, it was a deliberate, strategic move by management. They consciously chose to dial back aggressive sales expansion and trade promotions in Vietnam to prioritize bottom-line profitability over pure volume growth at all costs. The critical takeaway here is this. We are dealing with non-permanent friction. These are temporary operational headwinds. Spot Robusta prices have actually already retreated from their mid-2025 peaks. That cost relief is going to filter straight through to the income statement by fiscal 2027 once the older inventory clears out. And that strategic pause in Southeast Asia, management can easily redeploy marketing spend to reignite aggressive volume growth across Vietnam whenever they choose. Neither of these factors breaks the long-term structural growth thesis. The market simply extrapolated the exceptional operating leverage of 2024 and 2025 as a permanent baseline, which, quite frankly, was always an unrealistic expectation. So what exactly is the market missing? We've got to zoom out from the short-sighted myopia and look at the multi-year vision heading into fiscal year 2028. Food Empire is executing a crystal-clear expansion pipeline designed to decouple from legacy risks in Russia and achieve a highly scalable Asian footprint. We're seeing immediate multi-year anchors being dropped, with Kazakhstan fully operational and capacity upgrades in Vietnam. Moving toward 2028, we see the unlocking of their global coffee legacy with a massive new $80 million spray-dried factory in India, plus freeze-dried facilities in Vietnam coming online. If execution stays on track, this is going to be a significantly larger business in 3 to 5 years. Right now, at a price of roughly $2.40, it trades at a forward PE of about 16x. But if earnings per share compounded even a moderate 12 to 15% annually over this period, today's valuation is going to look remarkably cheap in hindsight. Which brings us to the final word. The analysis is clear, but how does this actually translate to portfolio execution? Well, based on this thesis, the accumulation phase is completed. Over the past year, a position in Food Empire has been steadily built, averaging a price of roughly $2.44 per share, which results in a meaningful 4% portfolio allocation. This isn't just theory, it's backed by absolute confidence in this management team's proven ability to navigate tough, volatile operating environments while never taking their eyes off those long-term expansion plans. So the hard work is done. It's time to sit back, enjoy a cup of Café Po, collect those upsized dividends, and just monitor the expansion story as it naturally unfolds. The market will always have its mood swings, jumping at shadows and fixating on temporary friction. But the question I'll leave you with as we wrap up this explainer today is this. While Mr. Market panics over short-term commodity cycles and tactical pauses, will you be the one quietly collecting generous dividends as Food Empire's global expansion takes hold? Thank you for tuning in, and keep looking beyond the surface numbers.